Hi, welcome to Capital Grounds Podcast. I'm your host, Nick Miller. I'm here with my co-host, Joe Fisher. We're with SITG Capital, and this morning we're here to bring you some of the news going on in the real estate market and finance as a whole, talk about coffee a little bit, and dig into our topic of the day. But Joe, how are you this morning?
Hey, I'm doing good, Nick. How you doing?
I'm doing all right. I'm doing all right. Uh,
Yeah,
share
yeah.
with you.
Fine.
Go ahead.
Oh, I was just gonna say we're finally getting into spring now, so the weather's getting better. Things seem to
Yeah.
be picking up in some areas, so it's always a fun time of year.
Yeah, absolutely. Absolutely. Uh, for our viewers and listeners that don't know, I recently moved from Minnesota down to Kansas, and we've got our house under contract. We'll be looking to sell here in the next couple of weeks, sign closing documents. So, yes, spring is upon us, big changes going on. But yeah, let's dig in. I'll tell you a little bit about my coffee this morning.
Yeah, what do you
I'll
got?
tell you.
What do you got going on in the mug there, Nick?
Yeah, so we made this. We made this
Mhm.
last Easter. That's my daughter's
Oh,
footprint, and we
cute,
made
man.
these for all of our family members. And I'm drinking Major Tom Roast by Repetition Coffee. It's a Ugandan blend.
Ah,
It's pretty
okay.
tasty. Pretty tasty. I like it dark. I like it hot and black
Yeah.
as can be. So yeah.
Is
Anyway,
it low acidity level?
it's relatively low. It's relatively low.
Okay. All right. Then I
Yeah,
can get
it's
behind
not.
that.
Yeah, yeah, yeah. I'm not a big fan of acidic coffees. You know that, Joe.
Yeah, same,
Uh,
same.
but anyway, so let's dig
Oh,
in.
that's great.
Let's dig in.
Yeah,
Got
there's
some big
actually
things going
some
on.
there's actually some pretty big news, right? So we're a couple days removed from this, but some of the bigger news to come across here recently that's, affected our industry as well as, our previous industry, the working in financial services has been the collapse of SVB. So, Nick, I was hoping you could give us
Silicon Valley
just
Bank.
kind of a yeah, just kind of a high level overview of what happened there, and then I want to touch a little bit on regionally what we're looking at because most of our business, well, in fact, right now all of our business is done in Texas. So there's a big difference between what's happening here, what's happening in other parts of the country.
Yeah, yeah, certainly, certainly. I'll tell you, Silicon Valley Bank is the largest bank to fail since the financial crisis of 08, 09. And it sounds like things got kicked off about a week ago. They were looking to raise about $2 billion in additional capital. They had to realize about 1.8 billion in losses on the sale of some assets. Anyway, so that $2 billion capital raise is pretty significant. Pre-market trading Thursday morning, the stock dropped by about 60%. So, they had to freeze trading on that on Thursday. The attempt to raise capital didn't work. So, by Thursday, they were looking to or exploring the option to sell the firm. That's about the time regulators stepped in and took over. So the good news is, the depositors were FDIC insured up to their regular 250,000.
Right.
So, regulators mentioned that they should have access, depositors will have access no later than this past Monday morning. So that's good. And, it sounds like there may be some other trickle problems down the road, but I think regulators are setting up another emergency, uh, you know, cash
Mhm.
institution to help potentially other banks that are in dire straits, but
Sure.
it pretty big news. Pretty big news.
Yeah, it is.
Uh,
It is. And it's a little further reaching than I think I expected. I think, don't quote me on this, but I think I read that they were the 16th largest bank in the US, something like that. So, I mean, a pretty large financial institution, right? And I'm here in Dallas, so I read, Mark Cuban had some money there, and I'm sure he probably had more than 250K in one account, right? So he probably, might be on the hook for some losses there, as well as some other people. I know Nick, you and I talked to, a potential service provider not too long ago, and they said they had to pivot away from SVB because they were doing some uh, deposit accounts there. So I thought that was just pretty interesting to see how far reaching that was. But I think to your point, and one thing that I thought, to keep some perspective on is them, and then the other one, and the other one's I'm missing the name on it. It also started with an S, I think, but their exposure was quite different from what a lot of banks are. They had a lot of tech exposure, a lot of crypto
Right.
exposure, things like that,
Right.
things that are a lot more volatile than real estate or even just the overall stock market, right? So I think that played into it a lot, and just kind of created an environment that really wasn't great. But I do want to say, as far as regionally, we're looking at it because obviously this affects everybody in the U.S. and abroad. However, different areas of the country have different exposure to different things, right? So California, very tech heavy. While there's a lot of tech jobs in Texas, it's really not what Texas banks are lending on. I read a good article in the Dallas Morning News, and they interviewed the Texas Banking Associate CEO. His name's Chris Furlow. But basically, what he said is, we don't have a lot to be worried about. Even our larger banks, we don't have a lot to be worried about here. Regionally speaking, he said they're well capitalized, their asset quality is solid, diversified. And so, he's basically saying, which he probably should be saying, regardless, anybody should be saying this, but you should have confidence in the local banks. But again, to me, the thing that doesn't give me too much concern with any of the lenders we use is they are well diversified. They have a lot of different asset classes that they're diversified into, and they have solid loan uh, history, and they're not looking at a lot of defaults right now. So I think we're okay. And Nick, you kind of mentioned that too, that regulators were stepping in and doing a pretty good job. So while it's big news, I don't know that it's something that we should be overly concerned about at this point.
Agreed. Agreed. Like you mentioned, SVB in particular had a pretty large exposure to crypto and the tech world, and
Yeah,
I'm going to call those, non-traditional investments for banks, especially banks of
right,
that
right.
size. Typically they're much more conservative.
Yeah, absolutely. No, agreed. So, yeah, I think it's an interesting point, and a reminder of risk mitigation, which we're always big on, and making sure that you can diversify as much as possible, and have some cash reserves on hand too. So yeah,
Certainly, certainly. It's good to have a backup plan. Always good to have a backup plan. And, if you work with a financial advisor, give them a call, talk with them, see what sort of
yeah,
advice they have for you, and make sure that you're up to date. Like we've mentioned in our first episode, we all have, or all of us that are client facing, have a financial advice background. We're all licensed,
right,
and those conversations are important to have, especially, I mean, preferably before we have times of turmoil, but certainly in times of turmoil,
right.
it's key time to take advantage of the resources you have. But
Absolutely. No, well said, Nick. Well said. Um, well, if you want to, Nick, I think we should maybe move on to our main topic that we're going to discuss today, which we're going to be discussing REITs, a little bit of history on REITs, and then a little bit of pros and cons on REITs, and maybe some things you should look out for or you should be aware of as you're looking to potentially invest in a REIT, or see it as a avenue for you to invest in real estate, as a viable option for you, for some of your net worth.
Yeah, certainly, certainly. And for those listeners and viewers that maybe aren't aware, REITs stand for Real Estate Investment Trusts. And,
Mhm.
Joe, I'm sure this happens to you when you talk to people about what we do, but a lot of people uh, uh, think that we're REITs or that we operate in a
Right.
similar way. And to some degree we do, but, we'll dig into the details. And yeah, we'll have a conversation here about what sets us apart and what makes, private real estate investments different than how REITs are traditionally operated. So
Yeah.
yeah, I'll
Yeah.
tell you,
So go ahead, Nick.
yeah, I'll dig right in. Uh, I'll tell you, REITs originally came about back in the 60s, early 60s, I think
Mhm.
1960, in fact. President Eisenhower, signed legislation that created the vehicles for REITs to be constructed with the intent to almost do something similar to what we do here at SIPG Capital in trying to provide
Right.
more access to retail and regular investors to the private real estate markets and private real estate world. Um, and historically, depending on the REIT you look at, performance has been generally favorable, right?
Mhm.
Um, but uh, you know, when we set up that model for REITs, we really demonstrated to the rest of the world how that could operate and how that could bring a lot of great things to regular investors. And so there have
Right.
been a number of other countries that have adopted similar practices to us.
Yeah.
Joe,
Yeah.
yeah, dig into the details, if you will, some of the
Mhm.
specifics. We've got a framework, and then we can go from there.
Yeah, sure. And I mean, you bring up a good point there, Nick, because yeah, I mean, I got written down here. There's around 40 countries that adopted, a very similar model. So yeah, REITs were kind of the first, to your point, really first approach to making large commercial investments more accessible to the average person. So let's see, as far as what qualifies as a REIT, there's a couple things. So you've got to invest at least 75% of the total assets of that particular fund in real estate, cash, or U.S. Treasuries. You have to derive at least 75% of gross income for that fund from rents, interest on mortgage that finance real property, or real estate sales. So there's a couple ways to do it, but you have to have that 75% gross income mark. And then a big one is you have to pay a minimum of 90% of taxable income in the form of shareholder dividends each year. So that's the one that a lot of people, I think, know, more people know anyways. Um,
Sure,
I think that's a little bit more commonly understood. But there's a few other things that are thrown in there. You got to be an entity that's taxable as a corporation. It has to be managed by a board of directors or trustees. And you have to have at least 100 shareholders after the first year of existence. So if you want to create a REIT, you got to get to that 100 shareholder mark to maintain it within the first year of existence. And then you can have no more than 50% of its shares held by 5 or fewer individuals. So again, trying to distribute that, that wealth, I guess, across the whole shareholders in the REIT. So those are really, the big qualifying factors of how you get to a REIT, right? So,
sure.
Nick, I'll let you kind of dive into some of the positives of REITs. And to be clear, we at SITG do not have a REIT at this time. It's something we may explore in the future potentially. I think one of the big positives to me is that you can have a small amount of money and invest in a REIT, and that is a positive to me. But Nick, I'll let you go more into the positives. The things on the negative side that I want people to be aware of and look out for. So REITs don't often offer a ton of capital appreciation. Um, the reason for this, I think, is rooted in the fact that if you have to hit these criteria in order to be a REIT, right, you're probably going to overpay in some instances on some properties. You're not so concerned with getting value add type of properties. You're not so concerned with finding distressed properties in order to create additional capital appreciation through there. You're really more concerned with, okay, I need to find a stable property, really stable property that can pay out rents, or I can maintain the interest on the mortgages that are financed for that property. So it's very different from you going in and looking at a value add type of situation or a distress type of situation. So oftentimes you don't have a ton of capital appreciation, and really tied into that is 90% of that income is coming back to you, in the form of dividends. So you're going to pay a little bit more, from a taxable perspective. Um, in that regard, there's not as much flexibility as we have in some other things. Um, Another point I wanted to make is only 10% of the taxable income can be reinvested back into the REIT to buy new holdings. So it's harder for them to grow, unless they are taking on a lot more new investors, things like that. Um, so
Absolutely.
I think the biggest thing to me that's a drawback is because of all of those factors, right? And this is something you as an investor really need to do your research on. You're going to have higher management and transaction fees. And that's really big because that's going to hurt your return long term, right? And then the last point I want to make, and I'll turn this over to Nick so he can go through some of the positives of REITs, right? Is you really need to, as an investor, look at what they're investing in, right? So I'll use a local example here in Dallas. If a REIT were to buy one of these, large properties, you can see them on the Dallas skyline, built in the 80s, they might have 1 million square feet of office space, right? They're not going to get to 100% leased on that. They're just not. There's not an appetite for that right now. And in fact, there hasn't been for quite some time. Now, what people really want to see, would be a good mixture in a REIT. So you would want a little bit of office space. Office space is kind of out of favor at the moment, but the right office space makes sense. For example, Nick, in um, Uptown here in Dallas, they're building new office space there, Class A, beautiful office space, but they're on the smaller side. They might only be a couple 100,000 square feet, and those are getting leased out very quickly. But again, the ones on the other side that are a little older, 1 million square feet, you'd think, oh man, I could do so much with this. But businesses don't want to invest in that much square footage from an office perspective because there's a lot more flexibility now, right? So you need to look at what their portfolio is made up of, and you really need a good mixture in order to kind of ride out the waves of what happens in the real estate market. So, those would be my two big points when you're looking at a REIT, when you're going through, checking it out through your Schwab account or whatever you're using to look at that REIT and do some research. But Nick, do you mind taking us through maybe some of the good sides of what REITs provide?
Yeah, no, I think you hit the nail on the head, with a number of points. Diversification within the REIT is one of the perks, right? You can get exposure to a number of different areas in the real estate market that we, for instance, don't provide currently.
Right.
Additionally, as a retail investor, you've got very easy access to it. You can go to any number of online brokerage firms like Schwab or TD, although now they're the same. E-Trade, I mean, any number, and open an account for free, and within, a handful of moments have direct access to the real estate market. Um, and and I want to dig into some of the good things, but I also want to point out, uh, we'll cover this in a later episode, but this creates much higher demand, much more access, which means that you don't have quite the potential for, I'm going to say, a good deal, right? It's more
Right.
difficult to uh, buy these shares at preferred price. It's called price dislocation. So we'll talk about that in the next episode, hopefully. But when you've got so many buyers and sellers, the spread and the opportunity for growth is
Yeah.
much thinner because you've got people that are also looking for the same things that you do there.
Yeah,
But
we
I'll tell
talked about
you,
this previously, but the
yeah,
alpha as well. Yeah, to your point.
absolutely, absolutely. It's more difficult to gain alpha when
Right.
you've got so many different buyers and players in that field. Um, the flip side of that is that you've got a wide variety of different REITs out there. Just in the multifamily, REITs that focus on multifamily like we do, the top five REITs have almost $100 billion, just a hair under $100 billion in assets under management. So
Right.
absolutely, absolutely massive markets available for any specific REIT that you want, but also some of these more diversified REITs in general. And when you look at the top five REITs as a whole, they're north of 300 million, I think 360, 370 billion, sorry, billion with a B. Massive, massive, massive
Yeah.
markets.
Right.
But,
Yeah.
on the flip side of that, again, with that lower chance to develop and build alpha out of those portfolios, but you can get diversification across different real estate asset classes. You can get
You can. Yeah.
diversification across different locations across the US, potentially across the world. It just allows you to get exposure to so many different parts of the real estate market globally that
Yeah.
again right now we don't have access to. Um,
Right.
yeah, any
No,
comments,
that's a
Joe,
good
on that?
point. Yeah, I was thinking of something as you were saying that, Nick, because that's a good point. And I think if you're not an accredited investor, I think it's a good way to find some exposure. But again, do your research. And let me give you a case study as to why you should do your research, right? We're currently in the process of buying a property from a REIT. Now, that REIT is based out of Seattle. They own a property here in Dallas, and they've had a ton of problems just being able to manage it because they're absentee, right? So they're not here, they're not seeing what's going on a daily basis. They're not really in tune with the market outside of what they can pull from, say a co-star or something like that. But because I'm here locally, I know what some of the problems are. And I know that once we buy that property, we're going to be able to turn it around very quickly because it's a good property in a good location, with nice finishes. It's class A, but they've had a ton of problems just trying to get somebody to come in and manage it. In fact, they've gone through, I think, three or four property managers in the last, 6-ish months. So when you're a REIT, you're not as concerned about the property. You're probably going to be absentee because you are diversifying across the country. So it's just one thing to think about, right? From that perspective. And I do think, to Nick's point, there's a lot of good things to it. And again, if you're a non-accredited investor, I think it's a good way to maybe start off. But in my opinion, you're going to get a lot more potential for capital appreciation and really the things that you look for as an investor if you're looking outside of a REIT.
Agreed, agreed. And if you're watching this pod or this video, listening to this podcast, you're probably somebody who's interested in having more skin in the game in the real estate market and looking to really build some wealth using these great opportunities. You might have access to the real estate market in some of your retirement funds. There are a lot of target date funds, for instance, that rely on REITs to get exposure to the real estate market. But generally, I would imagine that if you are listening or watching this, you're probably exploring some of the deeper details, and REITs may not be, the best option for you. But
Right.
Joe, I think you bring up an excellent point. It's really difficult to know the ins and outs of the neighborhoods, the communities that you are operating in, unless you have, boots on the ground, like we do,
Yep.
like
The
we do.
OG. Yeah.
Yeah,
Yeah,
what'd you say? I'm
absolutely.
sorry.
BOG, boots on the ground.
EOG, absolutely, yeah. And
Yeah. No, you're right.
we talk about
Makes a big
this in
difference.
the previous episode. SITG, skin in the game. We invest in the properties that we purchase alongside of our investors. REITs, on the other hand, generally don't, right?
That's
They
true. Good
are,
point.
fee oriented. And when you are more focused on, getting a fee rather than providing the best for your investors, it can make it more difficult. Last year, 2022, terrible year for REITs as a whole. I think REITs,
Hmm.
$1.2 trillion total market. I think there are a couple hundred individual REITs out there available. And
Yeah.
I think last year they averaged 33% in the whole. So,
Oh wow. So yeah. Yeah.
yeah. And when
That's
we saw
worse.
rates,
That's worse than the stock market overall last year.
it, it certainly was. It certainly
Yeah.
was. Yeah. Yeah,
Right.
and a lot of that's driven by rate increases.
Hmm.
Just it's a different world. It's a different world than what we do and where we're at. We view real estate as a better play to manage risk, but it's
Right.
important to have skin in the game. But
Yeah. Well said, Nick. Totally agree. Um, I will say, if you guys have more questions about REITs or what we do, or really just any questions, you can send them to us. Subscribe to our YouTube channel. You can subscribe to our podcast as well. And you'll have an opportunity to send in questions. We'll do our best to answer those as we put out more episodes, even if it's on something we already talked about, like REITs. Happy to go back and discuss more, or get into some more details that we maybe haven't covered. So please let us know what you're
absolutely.
thinking about.
Yeah. And Joe, I want to cover briefly just kind of the differences that we see in what we do. We've kind of touched on a number of points, but for viewers or listeners who maybe haven't watched some of our other videos,
Sure.
we invest alongside our investors in the properties. We put a lot of the income that gets produced that doesn't get paid out. We're not bound by that 90% requirement. So a
Exactly.
lot of the revenue that we're able to generate once our investors get paid, we're able to put that money into new properties and create additional value for our investors, whether that's renovating a property, acquiring a property, building a property, or expanding regionally like we're trying to do. Uh,
Right.
because we're not bound by that 90% rule, it's much, much easier for us to create alpha.
Yeah,
And
absolutely.
like you touched on earlier, we've seen a lot of other spaces in real estate markets as a whole have a lot of difficulty the last couple of years, except
Hmm.
for multifamily. People need roofs over their heads, and
Yeah.
being able to really focus on the multifamily sector allows us to do good things for our investors, while we're specializing. And I'll tell you, even multifamily REITs last year performed poorly, which
They
is
did.
surprising
Yeah.
given the performance that we saw last year.
Right. Right. Yeah. No, well said, Nick. And I agree. And remember, we started with just investing our own capital. So, our number one priority is to be good stewards of our money, and we keep ourselves accountable by putting our own money in. So, to Nick's point, yeah, we're really focused on that, and we want to make sure we provide the best investments we can to our investors.
Great, great. Well, Joe, any additional thoughts during our chat today?
No, not now. I mean, I think just, reminders, subscribe to us on YouTube and podcasts if you want to listen in the car. And yeah, check out our website, sitgcapital.com. Send us an email if you've got questions. We're here to
Absolutely.
educate. Happy to help.
Yeah, send an email to us, and you'll likely hear from one of us directly. Would love to connect, and looking forward to some of our future episodes. We're going to have some great guests on. be able to have some better conversations around some of the specific topics we've kind of touched on. And I think there are good things on the way. So with that, Joe, I appreciate your
Always.
time. Thanks for having a
Thanks,
cup
Nick.
with me this morning.
Hey, man, anytime, you know it. So thanks.
All right. Take care. Bye-bye.
Take care. Bye.
Right. That was good.
All right. Feel good about it?